Hi everyone, welcome to our week number 8 video, our final week of the course. And so it's been nice working with everyone. I thought I'd go ahead and give you one last video, just covering what we had talked about last week in week number 7, and then going ahead and giving you a preview of week number 8. So in week number 7, as you know, we talked about income taxation and some of the differences between personal income taxation and corporate income taxation. We talked about ways in which tax liabilities can be reduced through a series of deductions, exemptions, and credits. And again, it's notable just how governments can use these types of circuit breakers, as we call them. Anything that reduces a taxpayer's liability is usually referred to as a circuit breaker. So how governments use these types of circuit breakers in order to not only reduce a taxpayer's liability, but also to try and encourage and change certain types of behaviors in the economy. Now we know with deductions, exemptions, and credits from our video last week that true tax credits tend to be by far the most powerful types of devices that governments can use, because those tax credits then come off of a calculated tax liability, as opposed to deductions and exemptions that are then taken off before the liability is actually calculated. As we know, there are a variety of deductions that governments can use, and they use those deductions not just to reduce tax liability, but they also use those deductions to encourage certain types of behaviors, and also to try and make sure that we're taxing our taxpayers on their net revenue as opposed to their overall gross revenue. So for these deductions, a variety of deductions exist. The tax code is thousands of pages long, and so far too dense and far too intricate for us to get into in our discussion here in this class. But some of the major categories of deductions are things such as the home mortgage interest deduction. We know that one exists in order to try and encourage our taxpayers to purchase homes, because that is seen as something that is very beneficial to the economy, a stimulus to the economy. And so we allow those taxpayers to deduct the amount of interest that they are paying on their home mortgages from their federal income taxes. We allow people to deduct charitable contributions because, again, that is a behavior that we want to try and foster and encourage among our taxpayers and citizens. We allow people to deduct medical expenses that are above a certain threshold amount. Again, you want to protect your taxpayers from circumstances that are beyond their control, and so you allow them to deduct those very high ticket type of medical expenses. Educational, job, or training expenses, again, out of the control of your taxpayers. So you want your taxpayers to not be paying taxes on their entire gross income, but rather try and tax them on a closer figure to their net income as you can possibly get. Moving expenses that are related to your job requirements, those may also be deductible, again, for the same reason, that we don't want to tax someone based upon their gross income. So the whole series of tax deductions are all there to allow for legal tax avoidance on the part of our taxpayers. Now, again, there's a big difference, as we talked about this past week, between tax avoidance and tax fraud. Tax avoidance is the legal use of existing tax circuit breakers to lower one's tax liability. Tax fraud is different because tax fraud is obviously illegal. So with tax avoidance, you are using these legal loopholes, whether they be deductions or whether they be tax shelters and annuities that are free from taxation, or anything like depreciation, things such as that are all within the tax code. Utilizing those to reduce your tax liability is certainly legal, and that's something that taxpayers are able to do. One way in which taxpayers can reduce their tax liability that we haven't really discussed a lot this week are those tax-free municipal bonds. Now, governments, as we know, whenever they construct their capital projects, if you had budgeting, you've talked about this, when they construct their capital projects, they typically do not pay for those capital projects out of their existing tax revenues, but rather what they will do is they will pay for those out of bond proceeds. They will issue debt and then repay that debt over a 20 or 30 or 40-year period of time. Clearly, the use of those types of bonds, and we'll talk about those when we talk about our preview of week 8 as well in a couple of minutes, but the use of those bonds is mutually beneficial to governments, but it's also beneficial to citizens as well. Because by using these bonds and by spreading out the payment over a 20, 30, or 40-year maturity schedule, you are reducing the incidence of taxation in the construction of that building in year number 1 or year number 2. Bonds also are beneficial in that they contribute to what we call intergenerational equity. In that if you are constructing a city hall that's going to be used for the next 50 or 60 years, you shouldn't ask that your citizens who reside in the city in year 1 pay for the entire construction costs of that building, because people who live in the city from years 2 through year 50 will still be using that facility as well. So you spread the cost out over future generations of users, what we call intergenerational equity. So it really behooves governments to issue bonds, but it also behooves citizens to purchase those bonds as well. Because what the federal government has done is for many municipal bonds, they have made the interest that is earned on those bonds tax exempt, exempt from federal income taxation. And for many years, we had this principle of reciprocal tax immunity, going all the way back to the 1800s, going all the way back to the case of McCulloch versus Maryland. And so since 1819, we've had this principle that one level of government may not tax another level of government. So whenever a government issues a bond, so a state government or a local government issues a bond, they borrow money, and individuals purchase that bond as an investment, those bonds typically have been exempt, at least the interest earned on those bonds have been exempt from federal income taxation. Because again, the federal government can't tax a state government instrument. Reciprocal tax immunity, like I said, had been around since 1819. It's been slowly eroded over the years. In 1986, Congress passed this big piece of legislation called the Tax Reform Act that we have mentioned before. The Tax Reform Act most notably streamlined the tax code and reduced the number of marginal tax brackets down to essentially 3 or 4 main tax brackets, just to make the tax system a little bit simpler and also to provide tax cuts to citizens. It was during the Reagan administration. But what some people don't also realize that the Tax Reform Act did is it created 2 different categories of municipal debt. It created what was called public activity debt versus private activity debt. Public activity debt would be something like a general obligation bond that a city will issue to construct a city hall or to construct a new police facility. That would be considered to be public purpose debt, and the interest that investors earn on that debt will remain exempt from federal income taxation. It's a pretty simple, clean-cut type of process. However, if you are issuing debt that is being used in a private type of enterprise, or if the money that is being used to repay that debt comes from a private sector enterprise, that debt may then be considered private activity debt. If it's considered private activity debt, then the interest earned on that debt is not necessarily exempt from federal income taxation. And what Congress did in 1986 is it actually set ceilings or caps on the amount of private activity debt that could be issued by state and local governments in a given year. And the cap was $50 million or $50 per capita. So if up to $50 million, private activity debt up to that ceiling, interest was still considered to be tax exempt. However, any private activity debt that goes above that cap would then be subject to taxation. And there are definitions in terms of what constitutes private activity and what percentage of revenue would have to come from a private enterprise to make it private activity. Kind of goes beyond what we're talking about here, but just for your purposes to know, Congress did reduce the likelihood that municipal bonds will be tax exempt with this Tax Reform Act in 1986. So not every bond that's issued by a state or local government is truly tax exempt. But for those that are public purpose types of debt, the interest on those debts will remain exempt from federal income taxation. So that is an incentive that the federal government is providing to citizens to purchase state and local debt. Because you remember, whenever state and local governments go out there and issue debt, they are competing with corporate entities that are issuing debt as well. Corporate debt often pays a higher return than government debt to the investor. So to incentivize the selling of that government debt, you make the interest tax exempt, and then that saves those taxpayers a little bit of money come tax time, and it makes it more likely that they will purchase that government debt. So these tax-free municipal bonds are another aspect of tax avoidance, another piece of federal tax law that allows people to reduce their tax liability. So if you have money sitting around, you want to invest it, you invest it in municipal bonds, public purpose bonds, you will be able to then shield some of the interest, the revenue that you're getting from that investment. Perhaps all of it you can shield from federal income taxation. But again, that's completely legal. That's the difference between tax avoidance and tax fraud. Tax avoidance is legal, tax fraud is illegal. So at the end of week 7 now, we have kind of dispensed with our discussion of taxation and the revenue side of the equation. Here in our final week in week 8, we will get into the topic of intergovernmental fiscal relations and how governments can influence the behavior and actions of other governments, other governmental economies. So how the federal government can influence state government and local government economies and the behavior of individuals in those states and those localities. It's what we call intergovernmental fiscal relations. We also this week will spend a little bit of time talking about some of the revenue sources at the state and local level and how those differ from federal revenue sources and some of the reasons why those revenue sources differ. And then we'll also talk about deficits and debts and how the existence of a deficit and the size of a debt can have an impact upon the economy and can have an impact upon the behavior of individuals and corporations within those economies. So where we're going to spend most of our time and the primary focus this week will be on intergovernmental fiscal relations. Intergovernmental fiscal relations is a large enough topic that it could take up an entire course in an MPA program. We're going to spend about a week on it in this class. What we're going to look at with intergovernmental fiscal relations is we're going to focus primarily on the tools that governments can use to shape the behavior of subnational governments and residents within those subnational governments. One primary tool that the federal government likes to use in intergovernmental relations is the use of grants. And you're familiar with grants, and for your discussion this week, you're going to be talking about different types of grants. But grants and aid are very old. They date back decades. They were used primarily in the New Deal for the revitalization of the economy after the Great Depression. We have several different types of grants that the federal government likes to use, and I typically like to present 3 different types of grants, kind of as a frame of reference. Revenue sharing grants, categorical grants, and block grants. Now, even though we mentioned revenue sharing grants in this class, you probably need to know right off the bat that revenue sharing essentially doesn't exist anymore. The federal government used to have a revenue sharing system whereby it would turn over a percentage of federal income tax revenue to state and local governments with really no strings attached. So state and local governments could take that money and use that money for whatever their hearts desired. The federal government had very little control, if any control, over how that money was being used. So with a revenue sharing type of system, it literally is just giving money to state and local governments, but not doing it for any ulterior motive, not having any other reason, not using that money to try and accomplish a federal goal or to get individuals or governments to behave in a certain type of way. Revenue sharing at the federal level was eliminated in 1986 by the Reagan administration. And it wasn't eliminated in the Reagan administration on philosophical reasons. Reagan agreed with general revenue sharing. he liked the idea of turning money over to state and local governments with very few or no strings attached. The problem, though, was in 1986 when general revenue sharing was eliminated. If you look at federal coffers, you realize that the federal government had no revenue to share. From 1969 until 1986, the federal government had run a federal deficit every single year for that 17-year period of time. And every year, the federal deficit continued to grow. So the federal government was spending more money than it was taking in, so there was no excess revenue for the federal government to share. So it was eliminated in 86 kind of out of practical as opposed to philosophical or ideological reasons. But I mentioned general revenue sharing, even though it's not around anymore, just as I said, for a frame of reference, because that's an example of the federal government providing grants without any ulterior motives, without attaching any strings or requirements to those grants. You compare that then to a categorical grant. Categorical grants are on the opposite end of the spectrum from general revenue sharing. Categorical grants have strings attached. They have rigorous reporting requirements. And when state and local governments receive those categorical grants, they may only spend that money for certain prescribed reasons. So the federal government can say, this categorical grant may only be used for A, B, and C. State and local governments, the recipients, may not then use that money for anything other than reasons A, B, and C. So a lot of strings attached. Categorical grants are a way in which the federal government can induce state and local governments to achieve federal objectives. So it's a way in which the federal government can have a direct and real impact upon the actions of state and local governments and residents in those state and local jurisdictions. So it's really a very strong tool that the federal government can use to intervene into state and local decision-making and state and local economies in order to encourage certain types of behavior. That's especially true when these categorical grants are also matching grants, when they have those matching components. And some of you may deal with matching grants in your daily life, but with a matching grant, the federal government will come in and say, we will match dollar for dollar up to a certain amount, the amount of money that the state government generates for this project or this program. So you may have a one-to-one matching grant where the federal government will say, we will match up to $100,000, the amount of money that the state generates for this project. So the state generates $100,000 for the project, then the federal government comes along and gives them an additional $100,000. Matching grants, obviously state governments, if it's a project that they want to pursue, they're going to love a matching grant because it may double the amount of money that they are able to generate for that type of project or program. However, the downside of matching grants is that they tend to distort or have the potential to distort the behavior of state and local governments. If the state was going to initially support Project A, and Project A would cost $1.2 million, and would give a benefit cost ratio of, say, 1.2. Project B produces a benefit cost ratio of 1.1. Based upon that cost benefit analysis, the state would normally pursue Project A. But then along comes the federal government and says, we will give you a dollar-for-dollar matching grant for Project B. That initially and immediately reduces the cost of Project B. And as you know, with your benefit cost ratio, if you are reducing your cost, you are increasing the resulting benefit cost ratio. So that 1.1 BCR for Project B with this matching grant from the federal government could very easily become a 1.3 or a 1.4 benefit cost ratio, which would then make Project B the more desirable project to fund. So you can see very quickly how matching grants have the tendency to distort local government preferences when they do occur. So that's one of the disadvantages of having this matching component associated with your categorical grants, or really with any type of grant. But categorical grants are on this opposite end of the spectrum from general revenue sharing. General revenue sharing, very few or no strings attached to the grant money. Categorical grants, a lot of strings attached and very rigorous and frequent reporting requirements. Then in the gray area in between the two, you have what are called block grants. Block grants require that the money be spent in a general program area. So you don't have to spend it in a specific way, but you have to spend it in a way that will help achieve the goals of this general program area. So it provides a lot more flexibility and a lot more discretion to local governments and state governments when they receive these types of block grants. In the Reagan administration, President Reagan was very famous for taking 187 categorical grants and combining them together into 13 block grants. Now, initially on face value, you would think that state and local governments would love something like that, because you're taking 187 of these very specific grants and you're transforming them into 13 general grants, block grants, that provide a lot of flexibility and discretion to the recipient. The problem was, though, as you probably have already guessed, as Reagan reduced the number of grants and transformed grants from categorical to block grants, he also reduced a lot of the funding. And so it's kind of a bittersweet pill to swallow. You got a lot more discretion and flexibility as a result, but you also got a lot less federal money in exchange. So it was that trade-off that state and local governments weren't terribly fond of. But we did see in the 1980s this movement away from categorical grants to block grants. You saw that movement in the Clinton administration as well. You saw that movement in the Bush administration, this movement away from specific grants to more general grants, providing a little bit more discretion. But now if the federal government really wants to achieve a certain type of objective, or really wants to push a local or a state government to do a certain type of thing or change their behavior in a certain type of way, you're much more likely to see them use a categorical grant as opposed to a block grant. Now, categorical and block grants can also differ in terms of how the money is given out. So they can be given out on either a project basis or on a formula basis. Grants that are given out on a project basis are competitive in nature. And so you'll have governments compete against other governments to put grant proposals into the federal government. The federal government will then pick and choose between those different grant proposals based upon their merits. So it's a very competitive type of process that pits one government, local government, against another local government for grant proceeds. Formula grants, however, are given out based upon formula funding. So you'll have a formula, you'll then take the characteristics of the government, the government that is petitioning or applying for this grant, and you put their characteristics into the formula, you work through the formula, that will then tell you which government gets the grants and how much money that government gets. Formulaic funding is something that is very common in education, and we see that a lot with the state funding of local education, where local governments, local school districts will get state funding based upon their enrollment, what we call their ADA. Here in California, they call it the P2 ADA, which is the ADA as measured in October of the fiscal year. That is what's considered your P2 enrollment. That's what is then the thing that's used to calculate your overall enrollment, your average daily attendance. That will go into the formula. The amount of unduplicated pupil percentage that you have, students who are English language learners, students who are in foster homes, students who are socioeconomically disadvantaged, SES disadvantaged. You put all those students together and create your unduplicated pupil percentage. That unduplicated pupil percentage will then also help dictate how much money you'll get out of this funding formula. There's also what it's called concentration funds. So if your unduplicated pupil percentage exceeds 55% here in California, then that local district is eligible for what's called concentration funds and will get more money as a result of this formula. So formulaic funding is very common in education, and it is based upon the characteristics of each of the local governments receiving the grant. The problem with project approach is that project approach really leads to grantsmanship. And it distorts some of the behavior of local governments in that they will put more of their time and more of their resources into finding people, professional grant writers, to write these grants. And that's one of the disadvantages and the negative artifacts you get out of a project approach to grant funding. But grants certainly serve as a primary tool that the federal government uses in order to alter or change the behavior of state and local governments and individuals within state and local governments. So it's a way in which the federal government intervenes. A second tool that the federal government uses are called mandates. And as you know, mandates are orders. The federal government comes in and orders a state or local government, or orders a business or individuals to take a certain type of action. That is direct intervention into economic behavior. Mandates will really have differential impacts upon state and local governments depending upon how much funding is associated with those mandates. So fully funded mandates, which are relatively rare in our system of federalism, will have less of a fiscal impact, obviously, than unfunded mandates. And that's been the big concern of state and local governments, is that they receive these mandates from the federal government, but these mandates do not come with the accompanying funding in order to pay for carrying out these orders that have been given to state and local governments. Great example of that is in terms of environmental protection and water testing. So we know we have a Clean Water Act at the federal level. Every state has its own version of a Clean Water Act. Some state Clean Water Acts will go above and beyond the minimum standards at the federal level. But either way, the federal government is setting minimum standards and will require state and local governments to test for certain types of organisms and particulate within the water in that state or local government. Well, whenever they say you must test for this type of microorganism within your water, it is oftentimes up to that local government to then pay for that testing. And if they find that organism within the water, then they have to pay to remediate that situation. And the federal government's not coming in and giving the money to either do the test or to attend to the problem that's identified after they've done the test. That'd be an example of an unfunded mandate, and we see that happen all the time. Obviously, when a local government gets hit with an unfunded mandate, it means that there's an opportunity cost. They have to spend their own source revenue to respond to and to come into compliance with this unfunded mandate. Then that means that there are other types of expenditures that they cannot make, and there are other types of programs and projects that they must divert that money from in order to put toward accomplishing the goals of this federal unfunded mandate. So the big question with mandates for state and local governments is just how much funding is associated with these mandates. But the type of mandate itself can also have a big impact upon the behavior of state and local governments and residents within those state and local governments. So one type of mandate is what's called a direct order mandate. A direct order mandate is when the federal government comes in and tells a state or local government, you must take this action under threat of civil or criminal penalty. You have no choice in the matter. That's a direct order mandate. Direct order mandates are used by the federal government when they have the constitutional ability to use a direct order mandate. So if it's something that the Constitution expressly provides that power to Congress, so when you read Article 1, Section 8 of the Constitution, you look at those enumerated powers. If this is something that is listed as an enumerated power of Congress, then Congress can issue a direct order mandate to carry out that power. So an example could be Congress's ability to regulate interstate commerce. That's an enumerated power. It's called the Commerce Clause of the Constitution. Congress, under that Commerce Clause, may be able to issue a direct order to compel state and local governments to take a certain type of action. And that the action that state and local governments take will then, there'll be a trickle-down effect to other segments of the budget and other aspects of the economy. And it's a way, again, in which the federal government can take a very direct role in influencing the economies in state and local governments. Second type of mandate is what's called a cross-cutting mandate. And it's called a cross-cutting mandate because it cuts across several different policy areas. The perfect example of this would be anti-discrimination. So you may not discriminate in terms of housing, employment, education, elections, so on and so on. It cuts across all those different policy areas. Cross-cutting federal mandates, anti-discrimination mandates, will have an impact upon how the housing market works within a state. It'll have an impact upon how education is being provided and produced within that state. So these cross-cutting mandates can have some very profound impacts upon the actions taken within those states in terms of delivering those types of goods and services and how the economy functions within those states. Those are called cross-cutting types of mandates. Anti-discrimination, again, is the perfect example. Third type of mandate is a crossover mandate. This is where the federal government will come in and say, if you don't do what we want you to do in this policy area, then we're going to take money away from you in this other policy area. And we see crossover mandates used a lot in the area of transportation. So the federal government comes in, and the federal government did this as long ago as in the 1950s and the 1960s with the Highway Beautification Act. So the federal government came in and told state governments, you have to beautify your highways. You have to remove billboards. You have to move billboards a certain number of feet away from the road. You have to do this to try and clean up your highways. If you don't do this to clean up your highways, then we're going to take federal transportation money away from you. That was the punitive measure for noncompliance. We saw this same type of thing again with speed limits, where the national government, the federal government wanted to come in and say every state should have a 55-mile-per-hour speed limit. They wanted a national speed limit. Some states balked at that. Pennsylvania is a great example. And they said no. They told the federal government to go pound sand. They said, we're going to keep our speed limit at a higher limit than 55 miles per hour. So the federal government said, that's all well and good, but you're now going to not get this federal transportation money anymore. And they took away what was called ICE-T money, the Intermodal Surface Transportation Efficiency Act money. And that's what funded a lot of highway construction and reconstruction many years ago. Pennsylvania lost out on a great amount of that money. More recent examples in the Clinton administration, again, keeping with the transportation theme, where the Clinton administration wanted every state to have a 0.08 blood alcohol content level for drunk driving. Well, at that time in the 1990s, states had different blood alcohol content levels. Some were 0.10, 0.12, 0.16. Clinton administration wanted everyone to have a 0.08 blood alcohol content level. Nowhere in the Constitution is the federal government given the power to establish blood alcohol content levels for drunk driving. It just doesn't exist. So since they couldn't do a direct order, what the Clinton administration used was a crossover mandate. So for states that did not adopt a 0.08 blood alcohol content level, they would then again lose federal transportation money. So that's called a crossover mandate. You don't do what we want you to do here, we're going to then take money away from you over here. And then the fourth type of mandate that the federal government uses to influence behavior and activity at the state and local level, what we call preemptive types of mandates. Preemptive mandates will take away the decision-making power of state or local governments in a certain policy area. The most common type of preemptive mandate is what we call a partially preemptive mandate. With partially preemptive mandates, the federal government will set a minimum standard. So the federal government does this all the time in environmental protection. So here is the minimum air quality standard, the federal minimum standard. All state and local governments are required to have laws that are at least as strict as the federal minimum standard. Now, states may go above and beyond that federal minimum standard, and that's what we do here in California. Our air quality standards are higher than the federal minimum air quality standards. You're allowed to do that. You're allowed to go above and beyond the federal minimum standard, but you cannot have a state standard that is less strict than the federal standard. That's called partially preemptive because your ability as a state or local government to have a less strict standard is preempted. You are no longer allowed to pass that type of law, but you are still allowed to pass a law that's more strict. So it's only partially preemptive of your decision-making power. Fully preemptive mandates, and there are fewer of these, completely take away a state or local government's decision-making power in that policy area. So a great example of that would be internet access taxation. So for many years, states would tax an individual's access to the internet. So every month you have an internet service provider. That internet service provider, whomever it may be, will charge you a monthly fee to grant you access to the internet. States would then tax that monthly fee that you were paying to your internet service provider, called an internet access tax. Federal government came along, Congress came along, and completely outlawed internet access taxes. So states may no longer have a tax on internet access. Now, they can have certain types of utility taxes that they can use a different name for that kind of have the same impact, but they can no longer have a true internet access tax. They are now fully preempted from being able to do that. So with mandates, they have a less direct fiscal impact than grants do, but those mandates can still have a profound impact upon the behaviors of state and local governments and the behaviors of individuals in those state and localities in terms of how they behave economically within those economies. Now, you may say, well, that's unfair. Why don't state and local governments complain about unfunded mandates? And they did. And they had a little bit of success with the Unfunded Mandates Reform Act. So in the mid-1990s, state and local governments have been lobbying for years and years and finally got this Unfunded Mandates Reform Act passed through Congress. Problem with the Unfunded Mandates Reform Act, I think we may have mentioned it before in this class, is that there are two problems. Number one problem is that it is not a proactive law, meaning that whenever Congress is discussing a potential mandate, in order for the provisions of the Unfunded Mandates Reform Act to come into play, a member of Congress must rise to a point of order and literally stand up and say, Madam Speaker, this bill violates the provisions of the Unfunded Mandates Reform Act. If no one does that in congressional session, then the Unfunded Mandates Reform Act never comes into effect. And the second problem is the Unfunded Mandates Reform Act only affected mandates that were passed after 1995. So any mandates that predate the Unfunded Mandates Reform Act were completely untouched by the provisions of the Act. And essentially what the Unfunded Mandates Reform Act said is that if a mandate that was being considered by Congress imposed a financial burden on states above a certain threshold amount, so a cumulative impact on states above a certain threshold amount, then Congress would have to go to the Congressional Budget Office, have the Congressional Budget Office put together a specific estimate, and then if it's above that threshold, then Congress would have to at least partially fund that mandate and provide some financial resources to states to carry out that mandate. Now, that's what the Act actually said. The fact of the matter is the Unfunded Mandates Reform Act has really never truly stopped a mandate from being passed. What it has been successful at doing is it's been successful at making the implementation gradual. So it's required Congress to gradually implement these mandates so that the annual impact on states would be below that threshold amount. So it hasn't stopped mandates, but it has affected the way in which these mandates have been implemented. But grants and mandates are two primary tools that the federal government uses in intergovernmental fiscal relations to affect and influence the behavior of state and local governments and state and local economies. And we'll focus on a lot of that this week. We'll also talk this week about this concept known as source separation, in that the revenue that is generated at different levels of government will differ, in that the federal government tends to generate its revenue from an income tax to direct income tax, corporate and individual. State governments, they generate most of their revenue from sales taxes and income taxes, a combination of the two. Now, not every state. There are 45 states that have a sales tax. 5 states don't even have a sales tax. But most states will use sales and income in a combination for their revenue sources. And then, as we know, local governments get a primary amount of their revenue from property taxes, as well as local option sales taxes. And that's true here in California. That's how most local governments are funded. We do need to realize that that's California. And in other states, several other states, local governments also have access to an income tax as well. But as you can see, we kind of try and separate out revenue sources between our different levels of government so that one government will not interfere with another government's revenue source. Every session of Congress, a member of Congress introduces a bill for a federal sales tax. Now, we don't have a federal sales tax currently, but there are calls for a federal sales tax with every single session of Congress. One of the main reasons why it never really gets anywhere is that opponents will say, if you allow for a federal sales tax, you are going to erode the ability of state governments from generating sales revenue. You're going to have an impact on the economy. You are going to distort the economy, and it will not be economically efficient to have a sales tax at the federal as well as at the state and the local level. But we'll look at different levels of government and talk about the different sources that they rely upon. And then we will also talk about deficits and debt, because deficits and debt may have a large impact upon your economy and economic vitality. Now, there is a difference between what is deficit and what is debt. And it's really important that we distinguish between those two. A deficit is an imbalance between revenues and expenditures in one given year. So we're looking at one given fiscal year. Do our expenditures exceed our revenues? If so, then we are dealing with what we call a deficit. Many governments deal with what we call structural budget deficits, in that they have, for year after year after year, situations where their expenditures exceed their revenues. Now, you might say, well, how's that possible at the state or local level? Because the state constitution prohibits the state government and local governments from running a deficit. Well, there are a couple different ways in which these governments can mask a deficit and make a deficit look like it's not a deficit. One way is to take money from an ending balance and use that money to eliminate the deficit. So if you're in this given fiscal year, your expenditures are outstripping your revenues by $1 million, but you have a $4 million ending balance from last year in your general fund, you take $1 million out of that ending balance, you put it towards your revenues, and lo and behold, your deficit has magically disappeared. But your ending balance has also gone down from $4 million to $3 million. You can only do that for so long until your ending balances dry up. And once the ending balances dry up, then in order to avoid a deficit, you'll then use the second strategy, which is borrowing money, short-term borrowing. And so what some governments have done when they've gotten to the end of their fiscal year and their expenditures exceed their revenues, and they do not have an existing ending balance that they can borrow from and take money from, then they will issue short-term, what we call notes. And these are short-term borrowing mechanisms that will give them an influx of revenue instantly that will then allow them to balance their books in that fiscal year and avoid a deficit. Now, that borrowing has to be paid back eventually. And so you're basically just taking the problem and you're pushing it off into the next fiscal year. It's not a good practice, but it's a practice that governments do in order to maintain compliance with the state constitution. Because the state of California requires that state and local governments do not operate at a deficit. Most state constitutions have that same provision for their local governments as well. Now, if you are running a deficit every single year, like the federal government has done, then you end up with the accumulation of those fiscal year deficits adding up into an overall long-term debt. If you look at the federal government, and you look at the deficits run by the federal government, you'll see that the federal government has run a deficit from 1969 all the way up to 2018, with the exception of 2 years. At the end of the Clinton administration, for 2 years, the federal government was actually in surplus spending. Now, the reason why the federal government was in surplus spending, it's kind of a confluence of several different factors. We had some general tax increases in 1990 and 93 and 97 that provided for an influx of revenue. We also had some pretty draconian cuts to programs in the 1990s, especially in terms of federal employment. And we saw a reduction in federal employment of 325,000 positions, many of those positions in the military. But what really contributed most to the elimination of deficits is the quickly growing economy. And I don't know if you follow the news in terms of economic growth, but we tend to measure economic growth on a quarterly basis in this country. Those are really the numbers that matter. And typically we're usually running about a 2% economic growth rate, which is pretty good. It means the economy is going along pretty well. Compare that to the late 1990s, mid to late 1990s, when you had quarterly growth rates of 6, 7, and 8%. One of the reasons why the economy was growing so quickly back then was because of the dot-com boom in Silicon Valley. And that was greatly adding to the revenues that were coming into the federal government coffers. That was growing the economy, and all that added up, the tax increase plus the spending cuts plus a quickly growing dot-com economy, all added up to give us surplus spending for 2 years in the late 1990s. September 11th then happened, and the wars in Afghanistan and Iraq occurred after that, and then you were back down into deficit spending, and we've just been in deficit spending ever since. So the federal government is very accustomed to deficit spending. And the more years where you run this structural deficit, at the end, you add it all up, and that all goes into your long-term debt. Now, not all of the long-term debt is made up of the accumulation of previous year's deficits. Some of the long-term debt is also made up of expenditures for capital projects, so buildings and things such as that. Whenever you borrow money to construct those buildings, that also then becomes part of your long-term debt. But a deficit's an imbalance in a fiscal year between revenues and expenditures. Debt is long-term. And it's important to make that distinction really, really clear. Now, governments don't always run deficits for bad reasons. It's not always because they're not bringing enough revenue, or they don't have the right revenue structure in place. It's not because they're necessarily overspending. Sometimes they do it strategically for counter-cyclical spending. As was discussed in some of the videos in this class, the federal government sometimes makes a conscious decision that it will spend more money in poor economic times. So it will spend more money when it knows it's getting less in revenue. And that's obviously for the purpose of trying to kickstart the economy and for economic stimulation. The more money that you can put out there, the more likely it is people will end up spending that money and will stimulate the economy and create jobs and all those good things, which in the long run, under dynamic scoring, would then mean that you'll end up having more revenue in the future. Now, sometimes that happens and sometimes it doesn't. But counter-cyclical spending is a valid reason for running a deficit, especially at the federal level, but it's not a valid reason for running a deficit every single year since 1969, with the exception of 2. The reason why we continue to run federal deficits is because we do not have the political willpower to either increase revenue or decrease spending to the level that we need to in order to balance our budgets. Now, countercyclical spending, again, is a handy tool for the federal government, not so much for state and local governments. And that's one of the reasons why we don't see deficits nearly as much at the state and local level as we do at the federal level. So deficits are imbalances in a given fiscal year. Debt is long-term, and not all debt is bad. Again, if your debt is made up of previous year's deficits, that's bad. If your debt is made up of your attempt to try and avoid a deficit, that's bad. If your debt is made up of debt that you have issued in order to construct necessary capital improvements, that's not necessarily bad debt. So all debt is not created equal. So if you're issuing debt in order to purchase a new fleet of police vehicles, they're going to be used and they're going to provide for public safety. And that's not necessarily a bad type of debt obligation to take on. There typically tends to be 2 different types of debt that governments use: long-term debt and short-term debt. Long-term debt are usually referred to as bonds. Short-term debt's usually referred to as notes. One of the more common types of long-term bonds is what's known as a general obligation or a GO bond. GO, general obligation bonds, typically require a 2/3 majority approval by voters. And the reason why we require a supermajority approval by voters is because those bonds come with what we call the full faith and credit of the government. So when a government issues a general obligation bond, that government is pledging its full faith and credit to pay this bond back. In other words, the government is saying, we will do whatever we need to do. We will use all of the resources at our disposal in order to repay this debt. If we need to raise taxes, we will. If we need to cut spending and lay people off, we will. If we need to sell buildings and liquidate assets, we'll do that. We'll do anything it takes in order to repay this debt. So general obligation debt comes with a full faith and credit guarantee from the government, which means that it's the cheapest type of debt that a government can issue. Now remember, whenever investors are purchasing debt, whenever they're deciding which debt to invest in, there's the risk and the reward calculation that they make. So the lower the risk to the investor, the lower the reward that they get in terms of the interest rate they get to cash in on. The higher the risk, the higher the reward. General obligation debt is very low risk for the investor because they know the government will give its full faith and credit to do whatever is necessary to repay it. So they get a very low return rate on that investment. Costs the government much less money to issue a general obligation bond. Coupon rates on a general obligation bond can be as low as 3 or 4%, very low types of interest rates. Another type of debt that governments sometimes use, what's called revenue bonds. You know, with a revenue bond, what the government will do is, say, for example, it's going to build a recreation center, and it feels a recreation center is necessary. And it's going to pay back the debt that's going to issue to build that recreation center and operate the center through fees that are going to be charged to citizens who use that center. So it's a revenue generating type of endeavor. In that type of instance, the government may be able to issue a revenue bond and then secure the repayment of that debt through the fees that are being charged for citizens using that recreation center. Now, the nice thing about a revenue bond is that for the government, there's no full faith and credit provision. The only thing that the government is guaranteeing is that the revenue we generate from the rec center will be used to then repay the debt. Now, if the rec center doesn't generate enough revenue and the rec center goes belly up, well, then the investor is just out of luck. But the government doesn't have to go and raise taxes to pay that debt off like they would have to with the general obligation bond. So the revenue bond, there's a lot more risk involved for the investor, which means there needs to be more reward. And so the coupon, the interest rates, when we say coupon rate, a coupon rate is what we normally say is an interest rate. So with bonds, we call the interest rate a coupon rate. And that's just an artifact of years ago when people used to invest in bonds. When they would purchase the bond, they would end up getting a coupon book. And they would rip off those coupons every quarter whenever their interest was due, and they'd send the coupon into the government. The government would then send them a check. That's why it's called coupon rates. You know, obviously, we don't use coupon books anymore. Everything's done through electronic funds transfer, much more streamlined electronic process. But still today, old school folks in government finance will still refer to interest rates as coupon rates. So the coupon or the interest rate on a revenue bond is going to be higher than a general obligation bond. So a revenue bond is going to be more expensive for a government to issue than would be a general obligation bond. Again, that risk and reward type of calculation. There are other really unusual types of devices that governments use that we won't get into, but things like lease rental bonds, lease revenue bonds. There's one really dangerous type of bond here in California known as a capital appreciation bond, otherwise known as a CAB, a CAB. And a capital appreciation bond is kind of like what we used to call a zero coupon bond in other states. And that with a capital appreciation bond, the government does not pay interest rates throughout the life of the bond. And all the interest rates all accumulate until at the end of the capital appreciation bond's maturity, there is a big old balloon payment that the government then has to make. Well, that's really dangerous because once you get to the maturity of that capital appreciation bond and that big balloon payment is there, if you as a government, you don't have the revenue to make that balloon payment, what do you have to do? Well, you either default on the debt, which will ruin your bond, your credit rating, or you have to then refinance it into more expensive debt, and it's just a self-perpetuating cycle of debt. So California has actually stepped in and really limited the ability of local governments using those types of capital appreciation bonds. But typically what we see governments use general obligation bonds. Most of the time, those bonds require a 2/3 majority approval by voters. In some instances, like with school districts, you can issue a general obligation bond with only 55% approval. You no longer need the 2/3. And that's what's known as a Prop 39 bond. And Proposition 39 allowed school districts to issue general obligation bonds with only a 55% voter threshold as opposed to 2/3. But for long-term debt, we're usually talking about bonds. Short-term debt, we usually call those notes. Short-term debt usually comes to maturity within 1 year, which makes it obviously short-term. Some of the more common types of short-term notes we see used are things like revenue anticipation notes, or RANs, R-A-Ns. A revenue anticipation note, if you get to the end of your fiscal year and you know you have revenue scheduled to come in the beginning of the next fiscal year, you can issue a revenue anticipation note, get the money now in this fiscal year to avoid a deficit, then repay that revenue anticipation note with the revenue that comes in at the next fiscal year. Now, obviously, there's going to be some interest to pay, so it's not a good practice, but it's a practice some local governments have to do in order to avoid a deficit, which they are constitutionally prohibited from running a deficit. Another example is what's called a tax anticipation note. So if you have a certain form of taxation, like property tax revenue, that is scheduled to come in a couple months, issue a tax anticipation note, then use the proceeds of that note in order to offset a deficit for this fiscal year. GANs, you might be able to guess, that's a grant anticipation note. BANs are bond anticipation notes. And so these anticipation notes are very frequent devices that are used by governments to try and avoid a deficit in a given fiscal year and then pay the debt off once the new fiscal year begins and that revenue source then kicks in. But again, the running of deficits and the maintenance of debt can have impacts from a macroeconomic perspective. That running these deficits may be done to stimulate the economy and to stimulate the purchase of certain types of goods in certain segments of our society. The running of a large debt that is an accumulation of year after year of deficits usually has an anchor effect on the economy. And the more debt that you accumulate, the more debt you run, the more it brings down your economy because it makes it more difficult for you as a government to make money available into your economy, and makes it less able to get an influx of revenue out there into the economy to then stimulate the economy. But deficits and debt are, again, tools that can be used by the government to either stimulate the economy or to slow down the economy, depending upon the current status of where the economy is at. But we'll talk more about those deficits and debts during this week. Just as another reminder, though, since we are in our final week together for this week 8, you have your discussion board assignment, and discussion board is just a text-based discussion board assignment for this week. So you'll be comparing the different types of grants, kind of like we did in this video and discussed in the book, telling me what the different types of grants are and give me some examples of their advantages versus their disadvantages. As always, please remember to respond to a couple of your classmates as well. And then also this week you have your critical assignment. I've had that available for you in the week 8 learning module for the past 3 or 4 weeks. Hopefully you've gotten a start on that. You made some headway on it. But that is also due this week. And just as a reminder, since we are in our last week, the due dates are moved up a little bit. Check the syllabus for those, but both the discussion board and the critical assignment are due earlier in this week than they normally have been in previous weeks. So I think that's more than enough. I'm sorry I talked very long again. I tend to do that in these videos, but I hope the information is useful and kind of puts the textbook information in a better context for you as we wrap up the class. I'll probably check in again as the week goes on near the end of the week and might put a conclusion video up for you just to kind of wrap everything up and make sure that we're all on the same page and finish up the class well. I'll have your week 7 discussion boards graded as quickly as I can get those graded. The ones I reviewed so far, again, have been excellent, and Have been no issues there, along with all the rest of the work you've done. It's been a pleasure working with everyone, but I will check in again before we're done with the week. So hope everyone has a great week, and I'll talk to you again in a few days. Take care.